Welcome, everyone, to another episode of The Everyday Trader. Good to be back with you again. This is Greg from Options Animal. Glad to be with you. Here with my friend and partner, Eric Hale.
Eric Hale from Trader Oasis. Hey, Greg, where you been? People are asking. It's been a long time since we've done an episode.
Well, I've been gardening. No.
You have been gardening, and I know
I have been gardening.
The bakery's going on, and we've been really busy. And we did a ton of travel. I mean, we talked about in the last recording, I was a little hyper, and I said I biked 522 days. It was actually 522 miles. But so I did biking across Iowa. You and I were in Wyoming, out of Jackson Hole. And we were also fishing in Maine at Camp Kotok. And I just know that I had a lot to catch up with. And it's been a busy week just trying to get back up to speed since the last time we recorded.
Yeah, that's been obviously the same. We've got some exciting stuff going on, obviously, of what you're working on with Trader Oasis, and some exciting things going there. So had our heads down doing a little bit of work, but we figured we need to get back in front of you guys and talk about, well, a pretty important event that's going on out in my backyard right now. I say my backyard. As for those of you who don't know where I live just on the west side of the Teton Mountains,
just over the hill
from Jackson Hole, where there's currently a conference going on sponsored by the Kansas City Federal Reserve, and Fed Chair Powell was there in present and talked about the fact that the economy is doing really well. In fact, better than they thought it would doing, considering they've raised 500 some basis points in the last 18 months. But also suggested that maybe they're approaching a slowdown in Fed rates right now. They may even pause in September. Seems to be in the short term. Markets rallying on that today. Now we'll see as we digest more of his comments, because also is very adamant that he feels that the Fed has a long way to go to bring inflation back down to target as well. I've just seen the Twitter feed going crazy right now about Lagarde, who is currently speaking. You know, she is, of course, the chairperson of the European Central Bank. She seems to be a little more hawkish right now than Fed Chair Powell has said. So I know it's sometimes hard to read the really short-term reaction to their speeches. And I know we only have, the time we're recording this right now. I know you're going to watch it later after the markets close. We got about 15 minutes before market close, and the markets are really rallying on the back of Powell's comments. What are your thoughts, Eric? Big picture on what Powell said so far, and is this tradable? What does this mean?
Tradable. First of all, I think I could have wrote his speech. I mean, as last year was the 7-minute speech where he said there will be pain, and this was definitely toned down. And he said he was going to talk longer, but I don't think it was much longer than I don't know, maybe 10 minutes or so. But he didn't really say much that we hadn't heard before. In that, inflation, they don't think they're done. And they may have to raise rates. And if we look at the September meeting, it's unchanged, really. There's a 20% or a 19.5% probability of a rate hike. But where we did see a change is if you go to the end of the year, we are now greater than a 50% probability of a rate hike. So we're current in this 525, 550 range. So by the end of the year, there's still a slight chance of a cut even by the end of the year. So you got to take these probabilities with a grain of salt. And it's the direction that I look at is which way did it move? And as far as the probabilities, I think they could be off. I'm in the camp that we will have another rate hike by the end of the year. I don't think inflation's under control. There's pressure to skip. And the Fed, I don't know. We still have inflation issues. And I think due to base effect, we're still going to see some numbers that aren't going to look so good. We got PCE coming up next week, and as well as a jobs report. So the labor market I expect to be really strong, and the Fed's going to be data dependent. If labor market gets really bad and PCE drops, then no, there's no rate hikes. But I think we're still going to have a rate hike. But it's funny. People want to know how many rate hikes. That's one of the things we talked to the former Fed president and in Maine. He's like, he was very candid and said, we don't know how many rate hikes it's going to be. It's going to be data dependent. So yeah, same thing. It's going to be data dependent. And right now, I look at the economic data and think that there's still reason to be hawkish. And I think that's the language. So the Fed was pretty good and pretty clear. Nothing. I think they did a pretty good job of threading the needle of being between hawkish and dovish, and the market sort of responded to it in kind with a little bit of a rally going into the close. So we have to see what Lagarde said, but yeah, there was only one of the big events that happened this week. The other event, which earlier in the week was billed as being bigger than the Fed announcement, was what was it, Greg?
Oh, some tech company putting fiber optic cable underneath the ocean to build out the internet.
No, that's a different company.
That's a different bubble.
Different bubble.
That's a different bubble.
No,
20 some years ago. Almost, yeah, 25
We want
years.
to talk about NVDA, which had a pretty amazing move. Or I shouldn't say pretty amazing move. It was up almost 4% yesterday, or even after hours. Yesterday we hit about 3%. And then it came back down the end of the day. So it kind of rallied right back to where it is. Nothing like this previous earnings event, which just blew the doors off. First of all, NVIDIA's numbers are phenomenal. I mean, you've got a $1 trillion company growing at 88% a quarter. That was the numbers, 88% a quarter. Just phenomenal numbers. And they're expected to do that. And if you've seen the street, I don't know if you saw that tweet that I put out there on all the NVIDIA upgrades. I mean, it's just across the board, 500, 600. There's one organization out there that has $1,100. Yeah. Is it tradable? That's actually what I wanted to share with people. Two things we wanted to talk about today is one is the Fed, and the other is trading on events like this. I think, I'm not a big fan of technical analysis. I think it tells you something, but when you take a look at the volume that we have traded, a number of shares that are traded on a stock, pick any stock. If you do the math, that works out to be about 2% of all the outstanding shares. Now, if I asked you, if I wanted to take a poll of people to figure out what everybody thought, how many people should I ask? And if I told you it's 2% enough of a sample, and that's essentially what you're doing, because only 2% of all the NVIDIA shares are trading. So I would think most of you will own NVIDIA, probably more bullish than what you might get from technical. So I would often say using technical analysis is like driving your car by looking through the rearview mirror. It tells you what happened in the past. Maybe there's some indication what could happen in the future, but these sort of moves that you get here, they are not foretold by stock charts, but there is data that show them, right? What is it? What do we look at?
Well, we look at options data. We look at implied volatility specifically as a measurement of expectation of movement and option. And I know we had a interesting conversation when we were in Maine with David Kotok, who's the sponsor of this event that we went to. And we talked about the pricing of options on a big picture, which are more of in a derivative scale. And he wanted to talk to us about that specifically, which we don't trade as much in the credit markets, have an understanding of a little bit. But one of the things that you and I are both really good at and have done for years is looking at this idea of hype and fear and excitement that gets priced into individual equity options, specifically surrounding things like you were just referencing, earnings events. And that's one of the easiest ways to trade a company that is obviously in the ether right now. I mean, don't get me wrong. I'm a fan of artificial intelligence. Just like 25 years ago, I was a fan of the internet and felt like it was changing the world. I do believe that artificial intelligence is changing the world. I do not believe that NVIDIA is a $1 trillion company. I believe this is a massive failure setting up from a long standpoint. That doesn't mean I'm short NVIDIA right now, by the way. I don't have deep enough pockets to short NVIDIA. I can trade it bearishly if I want to, but I don't think that's the right way to trade it. I think the way you've been sharing with the Trader Oasis community right now, some of the trades you've been doing is the right way to trade. I think you need to trade with options. Either that or you need to trade with the collar trade, which is what we teach people at Options Animal, which is equity ownership. But as much as I love NVIDIA and think it's an exciting story, they're trading at 30 times revenue. That's a lot of the future. I mean, we're pricing in an enormous amount of continued growth at this rate for like 10 plus years. Well, that's what JDS Uniphase did back in the internet bubble, because they were building out fiber optic networks. And was it critical? Was it in demand at the time? Yeah. Were they growing revenues at 100% a year, 200% a year? Yeah, they were for about 5 years. And then it fell off a cliff. That will happen with chips eventually. I don't know when that time is. So that's why I say maybe NVIDIA goes to $1,000 a share, $1,100 a share. But we also may have just seen the top too. So I actually think the best way to do the best way to trade NVIDIA right now is you've got to trade it with options. You've got to do some type of spread trade, whether that's in combination with stock like a collar, or whether that's the trade you shared over on Trader Oasis this week as well. So I think it's very tradable too. Just got to be careful.
Well, I'm going to take some exception to what you said there, Greg, because you said you don't believe that it's $1 trillion company. It's a $1.1 trillion company. Believe it or not, that's what it is. I know what you meant, and I agree. The question is it worth 30 times earning? Is it worth 8.8 times an Intel or 9.6 times an AMD? Is it the fifth most valuable public company in the world? It's now worth 3 times as much as JP Morgan. Is it really worth it? This came from the Marketeer on Twitter, and I just reshared this. And upgrades, as I mentioned, it's between 600 1100. These upgrades are just a jaw dropping from where they've changed. But you touched on something that I think is really important, and trying to navigate the future by driving your car looking through the rearview mirror hopefully doesn't sound like a good idea to anybody. And what we wanted to do, part of what we want to do here is help people learn and understand more about options and sharing some of what we do. And as well as I do that one of the best kept secrets for traders is understanding implied volatility. And implied volatility is something that everybody intuitively understands if you've ever purchased insurance. And when you look at the price of insurance varies depending. You can insure the same thing. My car, whether my wife is driving or my son is driving, the insurance prices are different. Same deductible, same terms, same value of the car. But why would one person be more than the other? Why is insurance more for him than it is for her? And the reason is just the risk is higher. And we call that risk component implied volatility. And that's exactly what it is. And as the name might imply, it's the, or you might, I hate to use the word in the definition, but implied volatility. If I asked you what that meant, you say, well, how much volatility is going to happen in the future? And it's precisely what happens. But the thing is, it can be overpriced and it can be underpriced. And this is where I think option traders really have an edge. Most of the market closed, or I just traded something. I just got filled on something apparently. Which is great. So anyways, there's 3 big things that affect the price of an option. Just like your car insurance, the amount of money that you're insuring affects the price. So if it's a $500,000 or a $50,000 car, $100,000 car, the insurance costs more for the more expensive car. So price. The other is term. How long do you want to have the insurance? So time. And the other one is the risk component or implied volatility. So stock price, time, and implied volatility all affect options pricing. And the implied volatility one, I tell people it's a little bit like an onion, because when you start to understand it, you realize there's layers and you got to get deep down into it. So I'm trying to make the case for why it's worth looking at. And this is from iVolatility.com. There's plenty of places out there to get this information. This is a chart of implied volatility index for NVIDIA. And NVIDIA has this pattern where you see a rise up and drop that happens 4 times a year. And now there's some other stuff in here that happens as well. But you see these patterns where the gold line goes up, and that's the implied volatility index. in a nutshell, it just means options are getting expensive. And then when it goes down, options get cheap. Now, the blue line here is the volatility of the stock. And so if we go back to here, this big spike, then I tell people volatility comes in two ways. It can come in bumpy roads. So here we have a bumpy road, then we have a very smooth road, and then we have a speed bump. So both are volatility. So bumpy roads or speed bumps, so both are volatility. So what we had was a speed bump, which was predicted. The market predicted that there was going to be a speed bump. But one of the things on these charts, and I like from ivolatility.com, is these are on an apples to apples basis, meaning that if the options were perfectly priced, this blue line would have jumped right to here. But the blue line went way past. And what that means is the move was bigger than anybody expected. So people who bought long calls or even straddles or strangles made money. Now, I've seen this play out, this story play out before in the past. And it doesn't usually happen 2 times in a row, because what happens is the market makers had to scramble hard. And don't worry about them, they made money, but they had to scramble hard to recover what happened, what occurred here. And so having the move be bigger, there's some people who are, especially if you were an option seller, you were on the wrong side of this. So what do we see happen when I've seen this pattern before, is when we've had these blowout moves, the market makers know this. And everybody wants to buy options because they say, gee, look what happened last time. It's going to happen again. So we see the price of options get really expensive. And what happened here, where's the move in here? It's hardly even noticeable that was earnings. Yesterday was earnings, hardly noticeable. So what did this mean in terms of option pricing? Was it overpriced or underpriced?
Yeah, it's way overpriced.
Yeah. And the people who sold options made money. Now, I am a huge believer in that nobody should sell naked options. I don't sell naked calls. I don't sell naked puts. I've done it in the past. I think it's a little dangerous. I think there's a much better strategy. And I went into a lot of detail with our community and shared this trade with people yesterday. So before the market closed, I placed this iron condor, which is a spread where you sell a put. So I sold a 405 put and sold a 510 put, and then bought long puts and long calls on the outside of it. So if you have just naked options, you bring in more credit, but you've got this huge potential risk that really just goes on forever on either side. So I can limit my risk to really a manageable number, and it helps if the trade does go against you, because you should always plan on the trades going against you. If the trade goes against you, you have potential to fix that or mitigate the losses. So this is the trade that I placed, which shows me not making any money unless a lot of time goes by. But because we had that massive drop in volatility, this big drop, this yellow line dropping here, what happened was, this is the trade today. So just with a drop in volatility, it's really simple to understand. I know some of you, your heads are probably swimming, but yesterday options were expensive, and I sold options. I bought some protective options way out of the money, but I was a net seller of options yesterday. Today, those same options that I sold, they're a lot cheaper. And I expected that to happen because of this pattern. Now, I wouldn't necessarily, if I had sold an iron condor, I'd be thinking about last earnings. I'd be thinking about my, how am I going to fix this trade? Because it would have been in trouble. And I think there would have been a path to success. But this is the secret that option traders understand, the ones who are smart. And I'm not saying most option traders don't get this. I'm surprised at how many people who trade options who don't even know what implied volatility is. And it is the reason, the value proposition for you is, why do I want to get to understand this? Is because it's tradable. And I think, to me, it's more tradable and more predictable than a stock chart and knowing where a stock is going to go. I know, Greg, if I gave you the choice, gun to the head, pick one. What do you want to predict? Implied volatility, or are you going to pick stock price? Which one?
Implied volatility every day.
And that's what you're going to predict. And that not everybody knows this, but everybody should know that. Everybody should know that implied volatility is far easier to predict. And in 3 more months, or 2 more months, what do you think is going to happen to this gold line? It's going to be back up here someplace. It might not go to 65, but it's going to be closer to 40. And we're going to see this rise up and then it's going to drop down again. It's going to rise up like a sawtooth. And we see this all the time. Another one this week, which was a lot of fun, was Foot Locker. Check out this. Look at this. It looks like it's like a heartbeat. 4 times a year, implied volatility does this crazy thing. And where's it going to be? It hasn't quite come down because Foot Locker was another one that had this crazy move. So anyways, I just wanted to throw out that there's better ways to trade if you learn and get some education. That's the payoff to people who are looking to try and learn more about options. And you hear people say, oh, I'm trading volatility. What does that mean? And there's different ways to trade volatility, but this is one of them.
Well, for those of you who are like, that was way over my head, don't worry, you'll get there. Come join us at Options Animal. We will teach you exactly what Eric was just talking about, because it does create a fantastic trading opportunity once you get it. We need to probably wrap up soon, but I wanted to throw in one more comment on Powell's speech. Can I go? But can I circle back to Powell?
Yeah.
So he said something, and I was trying to find it in the exact. I remember when I was listening to it. I'm scrolling through the text right now to try to find it, but I'm gonna try to summarize instead. It was something along the lines of what the Federal Reserve is doing right now is that they're navigating under the stars with cloudy skies or something like that in trying to determine Fed policy right now. And it took me back to a little bit of discussion that was had in Maine about there's a lot of uncertainty. The Federal Reserve is trying to make policy decisions on month-to-month data points. And I think they've done a phenomenal job this year, by the way. I'm of the opinion that Fed Chair Powell arguably should get nominated for a Nobel Peace Prize.
Peace.
A peace
Economic.
prize. Had he failed the Nobel Peace Prize at what I think is at stake right now for how well of a job he's doing. So hats off to the whole team. But I don't think, and admittedly, he is saying, we're not through this yet. So calm down, markets. I hope we're done raising rates. And that's what he's trying to insinuate. But keep your eye on data right now, because they're navigating by the stars with cloudy skies. They're hoping they're right. There it is, right there. You found it. It was the first part of the conclusion. The Fed's doing as good a job as they can with the data that they have, and they will continue to be data dependent. So like you mentioned before, I think it's pretty important that we keep an eye on growth and economic data, which all look pretty solid, but also keep an eye on inflation and make sure that does come back down before you start to get too over your skis bullish right now that this market's going to continue to trounce upward. All right, that's all.
Thanks, Greg. It was a good point. So appreciate everybody being here. Look forward to seeing you again. We'll try to get back to doing these more regularly. Hopefully what you learned today was helpful. So what do we ask people, Greg?
Like and subscribe. Ask questions. You have comments, questions, type them below. We'll try to respond as good as we can. Thanks, everybody. See you all next time.
Cheers.